Shannon, when we used to watch stocks, we never really used to factor in things like the dollar, but the dollar has been sliding. People are noticing, even stock pickers. Why is that?
I think people are nervous about why the dollar is weakening. And, I think one of the challenges is that perhaps foreign investors are thinking about diversifying their portfolios. There's other options now. There's bonds, there's potentially Japanese government bonds, there's gold. And so one of the things that's happening is with some of the policy uncertainty that we're seeing, foreign investors who are probably over allocated to the dollar over the last 10 years are just pulling back on some of that exposure in, kind of anticipation of, some potential changes in policy here and potentially some impacts on the budget deficit and growth.
Can you follow that all the way through? Say, all right, we have a declining dollar. We have some countries who don't want to buy treasuries. Just take it through all the way through the doomsday scenario, and then you can talk us out of it and not scare us.
Sure. I think the biggest challenge is that the weakening of the dollar is evidence that there is some treasury selling. And when you have treasury selling, what happens? The long end of the yield curve moves up. You could potentially see a 10-year that's above 5%. That has meaningful implications for borrowing for both businesses and consumers. And consumers, in particular, the housing market, which we have just been waiting for the catalyst for home buyers to be able to get back into the market and provide some additional affordability through a combination of more inventory and lower rates. So that doomsday scenario is the government has a pretty big bill to pay on an annual basis in terms of the deficit. Rates start rising on the long end. That creates even more pressure for fiscal sustainability and concerns about the deficit. That's really the worst case scenario. Our view is that this is more of a reallocation and not necessarily evidence of the dollar potentially losing its reserve currency status. At Neuberger Berman, we spend a lot of time thinking about that. We're just seeing sort of a shift, if you will, in terms of the relationship between different currencies, bonds, the other options that are available in the investable universe.
And we have seen a shift because a lot of money is going into international stocks. We've seen Europe do very well. We've seen emerging market stocks do very well. So in terms of allocating portfolios right now, where are you telling people to put their money? Where are you putting your money?
Well, our view has been for the last 18 months or so that we're going to see a broadening in the equity market. It was no longer going to be just those very large mega cap U.S. growth stocks that were going to contribute to the gains in the S&P 500. That broadening has actually started to encompass outside of the U.S. as well. So if you think about ex-U.S., think about what's happening in terms of Germany, the amount of fiscal stimulus that they're putting in, that is going to be more sizable than reunification. If you look at Japan and a lot of the changes that have gone on, not only in the economy, but as well as around shareholder value and the delivering of that by corporate executives. And then in emerging markets, there's likely to be some meaningful stimulus in China, which is probably creating a little bit of this sentiment despite the headline news about tariffs.
Let's talk a little bit more about those corporate executives. Are they confident about what's going on in America? Because when you put on the business news and investment news, all you keep hearing is that nobody can plan. So are we actually going to see problems maybe later this summer with regard to, we couldn't plan for that because of what's going on in Washington?
Our view is that confidence hit has already occurred. So if you go back to sort of right after Election Day, you saw a big spike in CapEx expectations from companies. You saw CEOs coming out and saying that they were going to be building and hiring and growing their businesses in 2025. Now, they've taken a little bit of a step back, but admittedly, they've been on the slower side to reinvest in their businesses the last number of years. So why not wait for that additional clarity in the second half of the year? There's also the tax bill, which is likely to include some very pro-business aspects to it that could encourage particularly investing in structures, major CapEx, and around the manufacturing and production economies, there could be some meaningful support there. So I think CEOs are just in a wait and see, and we're thinking about it in terms of more delayed expenditure rather than a damaged expenditure from this particular period.
But however worried or concerned corporate executives are, it's not stopping the dip buyers. So it seems as though there may be a reduction in confidence in corporate America. However, retail investor America, they don't care if stocks go down. They're going to keep buying. Is this going to become undone at some point, or should we keep trusting the buy the dip methodology?
Well, we had a very strong month in May, and that was partly due to dip buyers, but it's also because corporate earnings were pretty good. I mean, the S&P 500 posted 13% earnings for the first quarter. That was stronger than anticipated. And so there is a bit of a have and have not. If you look at very small private businesses, they're struggling a bit more. And we saw that data come out this week. But in terms of investors are buying based on the fact that company management continues to deliver on both the top line and bottom line, and at least at this point seem to be mitigating some of these pressures around costs and the potential slowing of consumer demand.
And then finally, can you give me your outlook both for the summer and then the rest of the year? Because there's still a lot of folks who say, well, you got a 30% chance of a recession, 40% chance of a recession. It's pretty high. So what do you think?
Well, there's a caveat here. Every year you start with about a 15 to 20% chance of recession. So I think that's important. We never really start with zero. And I think that it's justified to have some increased risk of recession given the fact that we're expecting prices to be a little bit stickier, a little bit higher. And we have seen some evidence of a more thoughtful or prescriptive or discerning consumer here in the US. We also have seen, obviously, that mismatch between imports and exports that meaningfully impacted Q1 GDP. But if you look at the second half of the year and you really think about, what might occur and how you want to be positioned, there is likely to be, sort of a continuation of this sort of slower growth story bearing out with the potential for investment going into 2026.
One more quick question. We went through this entire segment, didn't mention the Fed. Do they have a role in all this?
They do, but I think we really view them as being more of a policy taker than a policy maker. They're looking at what's happening in Washington. They're seeing what's happening with fiscal policy. Their concern is inflation. And frankly, that's been trending in the right direction despite this tariff threat. So as long as inflation continues to be disinflationary and we start to see that trend continue to move lower, albeit a bit slowly, the Fed has enough cover given the fact that we've only seen an incremental tick up in claims. The labor market is hanging in there in this low hiring environment. They're likely to cut 2 times this year. That's our expectation at Neuberger Berman, but it certainly will be something to watch in terms of their rhetoric in the July meeting.
All right. Well, thanks a lot for coming on and talking about it.
Thanks for having me.